In this week's video, we'll review charts from the past and present to help us answer the question, does 2016, 2017 look more like a major stock market top or a major stock market bottom? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. These charts will allow us to dive right into the question at hand. This is the S&P 500. This is a weekly chart. This is our generic and for illustrative purposes only 30, 40, and 50-week moving averages in blue, red, and green. You can see the topping process here. There's a sideways consolidation box. And we know when you get a breakout or breakdown from a sideways box, the longer you go sideways, the bigger the move that you can expect to get. In this case, the consolidation, the breakdown, was a bearish breakdown, and our moving averages changed from a full-bore bullish look to a clear full-bore bearish look. Very similar look and very similar situation when the S&P 500 peaked in October of 2007. We have a consolidation box, a clear bearish breakdown, and as we break down from the box, we're flipping from a full-bore bullish look to a clear full-bore bearish look, telling us that the probability of bad things happening was higher here and higher here than it was here or here. And in both cases, really bad things did happen. How does the exact same chart look today? It's the same weekly chart using the same weekly moving averages. Here's the U.S. election here. We also have a sideways consolidation box with some confusion here and indecisiveness, but in this case, the breakout was clearly a bullish breakout. Instead of getting a bearish breakout and the moving averages rolling over, we got a bullish breakout and the moving averages are turning up. We just went from a full-bore bearish look to a full-bore bullish look. It's pretty easy to see that the present day really doesn't look anything like this, nor does it look anything like this. If it doesn't look like a major top, does it look like a major bottom? Calendar year 2002 here, 2003. This is the same weekly chart with the same weekly moving averages. We have consolidation and indecisiveness. In this case, we get a bullish breakout. And as we break out from the consolidation box, the moving averages flip from a full-bore bearish look to a full-bore bullish look. Similar situation, calendar year 2009, where my cursor is. Here we go from a full-bore bearish look to a full-bore bullish look, but then we move back into somewhat of an indecisive phase here, and we get a long-term consolidation box. And very, very similar to this point here, we get a bullish breakout from the box, and simultaneously we're moving, in this case, from an indecisive look to a full-bore bullish look. How do these charts and these bottoms compare to the present-day chart? It's pretty easy to see that the present-day chart looks a lot more like these charts here and here than these charts here and here. A fair and reasonable objection might be, hey, you can't compare this period here and this period here to this period here, because in this period here we were coming out of a bear market, and in this period here we were coming out of a bear market. While that's a rational objection, there are also some rational answers. Notice this looks a lot like this here. We went from a long-term uptrend to a long-term downtrend. This period here looks a lot like this period here, meaning the turns look similar. But maybe more importantly, a bear market in stocks just occurred in most stocks in calendar year 2015 and 2016. What do we mean by that? It's not an opinion. We have facts to back it up. January 8th, 2016, USA Today article, the Standard & Poor's 1500 Index, a broad basket of large, mid, and small company stocks, shows that the average stock's distance from its 52-week high is 26.9%, according to stats compiled by Bespoke Investment Group through Friday's close, which was January 8th of 2016. So on January 8th, 2016, the average stock has already entered a bear market. The typical definition is a decline of 20%. And from here, things did not get better. They got quite a bit worse. From January 8th to February 11th, after this article was written, the broad S&P 500 lost an additional 4.83%. So you can easily make an argument that we did come off of something that looked a lot like a bear market, and a lot of stocks experienced a bear market. Is there a rational and plausible theory to explain why the typical stock in the S&P 1500 dropped well over 20% and the S&P 500 did not go into a bear market? You can make a case that the Fed propped up the markets by flip-flopping on interest rates, a topic that we've covered in the past. Yellen got to a point where she was talking about helicopter money. So every time the market started to fall, the Fed started to talk about more market-friendly policy. If you're relatively new to these videos, another fair question might be, we can't look like a major market bottom with the valuations that we have today. As we've covered in the past, we've had similar PE ratios to the present day within the context of an ongoing uptrend. Similar PEs near a major top, similar PEs near a major bottom, and similar PEs near a major bottom. It's very, very difficult to look at this chart, which is 100% based on facts, and make an argument that we can make rational decisions about timing based on valuations alone. Now let's look at long-term momentum. Does long-term momentum look more like a stock market peak or a stock market bottom? This is monthly MACD for the S&P 500 here. The stock market peaks early in calendar year 2000, and we get that bearish cross where black goes below red, telling us that long-term momentum is waning and rolling over. After this point here, really bad things happened. Similar situation in 2007. If somebody told you to take defensive action late in calendar year 2007, when we could see this bearish moving average crossover on monthly MACD, that would have been incredibly helpful, because after we could see this, really bad things happened. Conversely, if somebody told you early in calendar year 2003 that the outlook for stocks was improving, that would have been helpful. We get the binary opposite. We get a bullish cross with black going above red on monthly MACD, and a very, very similar look early in calendar year 2009. By mid-year, before mid-year, we have the bullish moving average crossover here. This is pretty much a mirror image of this look here. We want to avoid a look like this. We really want to embrace a look like this. How does the present day compare? If we look at these charts objectively, 2017, 2016 really doesn't look anything like the early stages of a long-term bear market. In fact, it looks quite a bit like these major turns here late in calendar year 2002, early 2003, and early in calendar year 2009. Like every chart used in the model and every chart described in this video, all of this speaks to nothing more than probabilities. The probability of good things happening relative to the probability of bad things happening. The probability of bad things happening never drops to zero. Having said all of that, this is a favorable look, and it really doesn't look anything like these looks here. We've covered these charts here numerous times, so we'll move quickly, and we're also going to expand on this market breadth analysis. This is NYSE new highs minus new lows. You can see a divergence started way back in calendar year 1998, and the stock market went up for almost 2 years while this divergence was in place. Point number one, divergences can be helpful, but divergences can be very, very early. If you got out of the stock market here based on this rollover look, you would have missed one of the biggest moves in stock market history in the late 1990s. Similar situation, but on a compressed time frame. When the S&P 500 made a higher high in October of 2007, this is the bull market peak here, we clearly had a negative breadth divergence in place. And if we're going to go into a long-term bear market, it's rational that at some point, new highs minus new lows is going to flip over into negative territory and into a negative downtrend. It's very, very difficult to say the present day market is unhealthy if new highs minus new lows is still trending in a positive manner, which is exactly what we have on the exact same chart on May 25th, 2017, We used this in an analysis on short takes on April 26th when the market had not yet made a high. This was actually a bullish divergence, and so far the market has held up and gone on to make a higher high. How do these charts here and these concepts here compare to a major stock market bottom? You can see market breadth started to improve dramatically in calendar year 2003 after the stock market had already bottomed. 2003 was a good time to enter stocks. They rallied all the way into October of 2007. Similar situation at the end of the financial crisis. We have a negative look, a turn here, a negative look, a turn here. The stock market bottoms here in calendar year 2009. How does the bottoming process in the present day compare to 2003 and 2009? Very, very similar situation. Stock market makes what appears now to be a major bottom in February of 2016. And it's hard to argue that the present day chart doesn't look a lot like this chart here. And it's hard to argue that the present day chart doesn't look a lot like this chart here. Again, speaking to long-term probabilities. These charts don't tell us really anything about what's going to happen on Monday or Tuesday after the long weekend, over the next few hours, days, or even weeks. We're talking about months and years. How about risk on, risk off asset class behavior? This is the S&P 500 here. This is a weekly chart. This is a mutual fund that tracks long-term treasury bonds. Think of it as TLT. You can see on the left side of the chart here, late in calendar year 1999, we have a full bore bullish look in place in favor of stocks, and then we convert. We can see this before bad things happen to a full bore bearish look in this area here. Very similar situation. People migrated from growth-oriented stocks into defensive-oriented bonds. In this case, we can use TLT because it was alive and kicking. It was not alive and kicking in this span here. Notice the S&P 500 peaks in October of 2007. When it peaks, we already have a negative look on this chart here, and we also have a divergence because this chart did not make a higher high in October of 2007. If we examine the same chart in the present day, instead of having a full bore bearish look, we have a full bore bullish look. Take a look at asset class behavior from a little bit different and longer term perspective. This is a monthly chart here. This is calendar year 1997. This is 2017 as of May 25th. Some of you may have already recognized that price action between 2001 and late 2016 appears to be forming what's known as an inverse head and shoulders pattern. This can be a bullish pattern after you break out of the neckline. This is a downtrend here. This is a consolidation or indecisive period here. We get a shakeout, a bigger shakeout, the last shakeout before a bullish breakout. What chart are we looking at, and what does it tell us? This is a monthly chart. It shows the performance of the NASDAQ Composite Index relative to basically TLT or long-term treasury bonds. We have a bullish breakout here. You can do a back of the envelope projection after you clear this neckline. And keep in mind, we're moving out of a 15-year base. The longer we move sideways, the bigger the move that we can expect to get when we get either a bullish breakout or bearish breakdown. And the back of the envelope projection literally goes off the chart. You know, chart patterns, it's hard to argue that this pattern is not a favorable look for equities relative to bonds from a long-term perspective. It's easy to understand how we could all, including myself, be skeptical about really good things happening in the stock market for an extended period of time. However, that type of skepticism fits the historical profile of a major turn in the stock market. If you ask somebody that knew about the economy and the markets in 1982, what were the odds that the S&P 500 was going to go into an 18-year secular bull market? They probably would have laughed at that point. It's a G7 statement, May 2016, and it pretty much summarizes what we've been hearing for a long, long time. It's very pessimistic. Global growth remains moderate and below potential, while risks of weak growth persist. We've seen numerous "we're all doomed" statements from global policymakers over the past several years. It's going to take some time, even if the charts are accurate and stocks are going to go up for several years. It's going to take some time to turn around the negative sentiment barge. This is a monthly DeMark chart of the S&P 500. This is calendar year 2013. Calendar year 2015 here on the right side of the chart. DeMark charts and indicators are proprietary tools from Market Studies, LLC. It's a holiday weekend, so we don't want to get into a lengthy discussion about the math behind DeMark counts. However, we do want to point out that something rare happened on this chart in 2013. An R appeared here, telling us that DeMark is recycling this exhaustion count. Notice, after the R appeared, the S&P 500, this is calendar year 2013, rallied for the remainder of 2013. It rallied for the entire calendar year in 2014 and rallied into the spring of calendar year 2015. Right side of the screen, we have a weekly chart of Amazon in 2017. Very, very similar to this point here. The math behind the DeMark count decided to recycle this count in March of this year. If you have access to DeMark counts and DeMark software, you will find that finding recycled counts on weekly and monthly charts is very, very, very difficult to do. It's very rare. And if you've taken the time to read Bloomberg Market Essentials DeMark Indicators by Jason Pearl, you might remember the appearance of an R is meaningful because it is an acknowledgement that momentum is very strong and that the underlying bull trend has intensified. The underlying bull trend has intensified. After this R here, and it's noteworthy, this is on a monthly chart and this is only on a weekly chart, so this one's a little bit more muted. After we saw the R, it told us that the trend had intensified and stocks rallied for the remainder of 2013, for the entire year in 2014, and into the spring of 2015. Very, very hard to argue if you know DeMark counts that recycling a count is bearish in any shape, form, or fashion. It's telling us that one of the leading stocks in this bull market had its underlying bull trend intensify. Another rational counter-argument to the present day might be, we just hit an all-time high. How good could things be going forward? Well, as we've noted many, many times in the past, new all-time highs really don't tell us anything about the market's risk-reward profile. Stock markets can make new all-time highs literally for years, years, and years. There are countless new all-time highs over this 6.3-year period, and as we noted in the past, between 2007 and 2014, how many new all-time highs were made in the NYSE composite? The answer is 1. The longer a market goes sideways, the bigger the move that we can expect to get. We either get a bullish breakout or bearish breakdown. In this next segment, we're going to be talking about managing risk and reward via portfolio construction. If you're a CCM client, these circles represent the percentage allocation to different portions of our portfolio. Our largest stake is in core positions that tend to have a very, very high correlation to the broad stock market and S&P 500. Then we have smaller allocations. One of them is allocated to an investment style, and the other one is a particular sector in the economy. And we also have smaller allocations to another sector and a third sector. We also have some stakes currently. Their allocations are much, much lower than the allocations above. Why? One reason could be that the position is a highly volatile position, and one of the ways that you can manage volatility is just to take a smaller position size. It's good to understand that these positions, all of them, could go to zero, and we still would be able to recover relative to the hit to our entire portfolio. That would not be true here. If this went to zero, it would be very, very difficult to recover from. There's a few reasons to hold these positions. It's possible that some of these positions, based on the facts in hand, will significantly outperform the core portion of the portfolio, allowing us to boost returns. If these positions are successful and they prove themselves, we could reallocate some of these resources up here to the better performing sectors. Conversely, if they do not prove themselves, we have not taken much risk relative to the percentage allocation. These positions down here also give us psychological options. Let's assume that this style investment doesn't work particularly well and starts to underperform, but something down here is outperforming. It's a lot easier psychologically to move money from an underperforming portion of your portfolio into something that you already own that is performing well, relative to admitting defeat on this position here and then looking for a new idea. These positions down here give us good psychological migration options if we choose to explore them. It's also important to keep in mind, even though we have sector exposure here, we always have exposure to all of the major sectors in the economy through our core positions here. These are just overweights relative to the S&P 500. It should also be noted that the investments related to Style 1 also have broad sector diversification. And with the chess moves that we've recently made, over 90% of our portfolio tends to zig and zag with the major indices. Zig and zag with the major indices does not mean you cannot zig and zag in an outperforming manner. But when we simplify and focus on the core correlations, it minimizes the probability that we get a major market direction call right and we don't take advantage of it from an investment or ETF perspective. The other 10% are in our portfolio for a reason. They look good from a probability perspective. The data still looks good, and it's possible that they could help us outperform and boost our performance. This sector over here also tends to perform favorably in environments similar to the present day. Always important to look at a gain or loss in the context of how much exposure we have. If you have a 20% exposure to a position and it's down 20%, that is radically different than a 20% decline in a position that you only have a 0.5% or 1% exposure to. The allocations are done for a reason. These are larger for a reason, and these are smaller for a reason. To quickly summarize the major topic of the video, do we look like a major stock market top or a major stock market bottom? Long-term trends, the charts say the star goes here. Breaks from the consolidation boxes, they're bullish breaks. Monthly MACD puts the star in this column. New highs and new lows unequivocally look more like a stock market bottom and really don't look anything like a stock market top. Our ETF scoring system tracks over 240 ETFs, and I can unequivocally say at the moment asset class behavior checks this side. We just showed via DeMark that momentum is probably increasing rather than decreasing in a leading sector and in a leading stock, star in the right column. And if we look at PEs from a historical perspective, it's very, very difficult to say they're a showstopper. It's very, very difficult to say that they add value really in any way. Thus, they do not necessarily negate anything on the right side of our screen. All of this is based on the facts in hand. The charts cannot predict the future. They can just help us with the probability of good things happening relative to the probability of bad things happening. And once again, everything that we've covered talks about the long-term outlook. It doesn't tell us what's going to happen Tuesday or over the next few hours or even the next few days. This is really weeks, months, and years from a probability perspective. We didn't see anything over the last 5 trading sessions that didn't align with that more resilient profile in the present day market. And as always, it's important for us to remember, if we want to successfully navigate from point A to point B, given that we know there will be 100% normal and to be expected volatility along the way, the only way that we can discern between volatility to ignore and eventually volatility to respect is if we review the new data that comes in with that always important flexible, unbiased, and open mind. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.